As the Federal Reserve coming under fire from President Trump again yesterday, he said interest rates should go to zero and then called Fed leaders boneheads. And this, of course, all comes during a season of falling rates, with J.P. Morgan CEO Jamie Dimon saying his bank is preparing for zero itself. Joining us now with her perspective on the Fed's path, Sarah Bloom Raskin, a former Federal Reserve governor and former Deputy Treasury Secretary. Sarah, great to see you. Just quickly, reaction to this CPI number, more or less on target on the headline number, but a little bit heavy, a little bit to the high side on the core number. Is this even really filtering much into the Fed's immediate equation and what they're deciding to do next week?
I would say no. The day-to-day movement is something that the Fed is going to be kind of wary of. What the Fed is going to stay focused on is the longer-term trends, where the inflation numbers are going, where the employment numbers are going, what the health is of the labor market, and of course financial stability. So the longer-term trends are what the Fed is focused on, and that's what they're going to keep their eyes on as they go into this next set of meetings.
Oh, given that the longer-term trends, by definition, don't change that often, I mean, you expect the Fed's going to give the quarter-point cut that the market now has priced in for next week, and then what? What would the message be, and what should it be thereafter?
Right. So the Fed, as you know, is facing an economy that is strong but is slowing. So we are seeing some flatlining in the manufacturing sector. We are seeing a lot of trade tension and trade volatility, waiting to see how those trade issues spill into consumer sentiment. Of course, the consumer piece is very important here because the contribution of consumption to growth is very high. So waiting to see really how these effects in trade and in manufacturing are going to affect overall consumption is something that the Fed is going to have its eyes on. And of course, continued issues regarding the low inflation rate and the fact that the price level has not gone to the 2% level that the Fed has set for itself as a symmetric target.
We mentioned the president's continued sort of public campaign to get rates lower and lower and lower and pressure on the Fed to do so. How do you think at this point that plays inside the committee room? And obviously, Fed officials, Chairman Jay Powell, have said all the standard things about how they don't think about politics or policy or pressure from outside. However, I wonder if the president saying that rates should be zero or below is so far from what the Fed is actually considering in the moment that it's almost easier for the Fed to say, fine, we'll cut rates if we see the conditions for that, because it doesn't seem as if they're bending to any particular political pressure if the political pressure is go to zero.
Right, right. So there's all these ways to do this reverse psychology when you have such, enormous and unceasing pressure coming from the White House on Fed policy. But here's the thing. The Fed is doing its best to really screen this out. They're going to screen out the noise as best as they can. The problem, of course, is that the president isn't doing the economy any favors with this kind of talk. Ultimately, we don't want people to lose confidence in one of the very important tools that our Congress has set up, which is monetary policy. It's important that the Fed stay credible. The noise coming from the president is really counterproductive to that, and ultimately to the economy and to economic performance. So it is problematic to have particularly discussions of tools that really are not fully understood, where studies have not yet been fully conducted or have been conclusive, which isn't to say that the Fed, doesn't consider these tools, because, of course, the Fed is considering everything and will consider everything should circumstances warrant.
Sarah, thank you very much. Appreciate it.